So today we have Josh Hanley. He is the lender that I've been working with since 2014. He helped me buy a home with like me being a dreamer with DACA. He
Nice.
helped me buy a home where like I had spoken to over 10 lenders, and they said no, we cannot do this, we cannot do that. But he was able to figure out, and he was able to help me buy my first investment property, then one of my first ones, then my house hack and a few others. So very excited to have him here. I know that a few of you guys also have used Josh, have worked with Josh in the past. So Josh, can you hear us?
I can. Can you hear me?
Yes, we can. Cool.
Okay, great. Hey, everybody. Sorry, I've been having some difficulties on my end over here, so I wasn't sure if you guys could hear me or see me or what's going on.
Okay, cool.
I
thought that you
had
were
to
on
use
your
my phone to
phone.
dial in.
I thought that you were on your phone, which is why we kept it a little bit longer too, because I was like, but I guess you were listening to us, so you're good.
Yeah, and I'm on the camera and I can see you guys, but for some reason my audio is not working on the computer right now, so I had to dial in, but I can see all you guys.
Okay, sweet, awesome. All right, well, guys, yeah, we just wanted to have Josh to see what kind of questions you guys might have as a way to asking questions about like whether homes for house hacking, for investments, questions about what we were talking about, like when you pull your credit and whatnot. But Josh, what I wanted to start is, what are you seeing right now on with the interest rates, with the market right now? Because I know that a lot of people have been seeing rates going up.
Well, yeah, so definitely that's in the forecast for the future going forward. You know, it's been a pretty volatile market here the last 3 to 4 weeks. You know, it all seemed to follow right after that freeze in that week when we were all shut down. A lot of people didn't even have service. A lot of lenders couldn't even operate. And then when everything came back on, we were shocked to see the rates had gone up almost 3/8 to 0.5% just in that week's time frame. So, I mean, a month ago, we were looking at best executed 2.625 on a 30-year fix on a conventional loan for a primary residence. Today, that's all the way up to 3.125, 3.25 with some lenders.
Oh, wow. And is there, what has caused that? Is there anything with the feds, or just new year?
Well, it's a combination of a few different factors. A lot of it is they are thinking that the economy is starting to really stabilize, and they're seeing things starting to improve. So they're starting to try and ease back a lot of these policies that they've had in place. And with that, the markets are reacting, and you're seeing the bond market go up, the stock market's reacting. And basically, you've got this stimulus package being rolled out as well by the new president in office. So that really affected the rates as well. And you know, they had them down so artificially low for so long to stimulate the economy, especially through these tough times. And now that things are starting to normalize a bit, we're going to see things start to get back to more of a normal level. And I mean, the numbers that we're hearing by middle to the end of this year, we're probably going to end up leveling off somewhere in the mid to high 3% range. So still good interest rates. And we're talking about primary homes here on conventional, not investment for the time being. But just to kind of give you a gauge as to where the market is. But that's where they're predicting they're going to go. And, you know, historically speaking, I mean, I've been doing this a long time, since 2000. So when I got into the business, rates were 6.5%, 7%, and people were paying a point or 2 points in origination to even get that rate. So anything below 4.5% or 5% is historically low. But, yeah, we're going to be looking at probably closer to the mid to high threes here come pretty soon.
Mid to high threes. Felipe, what are your thoughts on that?
You know, that's interesting because I almost feel like that's not a terrible thing. It just kind of makes it easier for me to continue to buy, because I feel like the market is getting stronger versus the economy trying to like help, or the government trying to help the economy. Like, I'm almost okay with it. Now, if it starts getting into the 4 or 5s, then I'll be a little nervous. But when I started researching real estate, like my mom, I believe her rate is at 12% on her house. Now, because of certain legal battles, she can't refinance it. I know Lexi, or I know, guys, it's crazy. I know some of you guys should give me crazy looks. But my mom bought her house a long time ago. So I saw her documents the other day, but 4 or 5%, I think is still okay. I don't think anyone here remembers when it was double digits, but I think that just means it's a healthy economy, and those things are not a bad thing. So get as much as you can while the money's cheap, because everything that goes down is going to go up, and vice versa. So I
That's
don't
true.
think it's such a bad thing.
I agree. And just like you said, just to kind of shadow off what you were talking about, and yeah, I'm probably a lot older than some of you guys, but I remember in, junior high going into high school, and my parents bought their first home. I think it was at 15% for a 30-year fix.
Yeah.
It was ridiculous. I don't think anybody could even afford to buy real estate here in Central Texas if that was the case.
Yeah, man. So then on the investment side, then if we have like mid threes or high threes on the investment side, we're looking at something closer to 5% for.
Yeah, I think we're probably a healthy level. It's probably going to be about where we were about a year ago. Probably be looking at about 4.75, 4.875 would be my guess on investment properties approaching the end of the year.
Mm-hmm. Man,
and that, obviously you guys all knowing that severely can cut into your cash flow, especially with rates right now being as low as they are, because I know some people were able to secure financing in the low 3% range on investment, which just really keeps that payment low and just keeps those positive numbers coming in.
Yeah. So let's say, asking for a friend, let's say that my friend has a property at an interest rate of 3.6%, and now he wants to do a cash out refi. It's an investment property. What would that rate be?
An investment property cash out, do you know what the loan to value is on that?
70,
the equity position?
Well, the property has appreciated over 100,000. So it will be like 75%, I guess. Yeah.
Okay, got it. So yeah, I mean, right now in this current market on investment, you're going to be looking at, let me say upwards of probably 4.25, 4.375
for a cash out.
Yep, for a cash out, up to 75% on investment property.
Okay, interesting. Because right now, from a 3.6 to a 4.5, the math really needs to make sense, and then be able to cash out all of that money.
Yeah, and a lot of that, and obviously looking at that, you want to look at the difference of what your payment's going to go up with the difference in rate versus, what your profit's going to be off of whatever you're taking that money and investing it into. So in the big picture, it still could make sense to make that move depending on what you're planning on doing with that cash, of course.
Yeah. Okay. Interesting. Guys, for anybody here, please put your questions on the chat, because we would want to ask them based on your situation or based on what you're seeing. Right now, we did ask them about the investment properties, cash out refis. Any questions that you have?
Yeah, I got a question. Josh, how do you deal with like for like partnerships where people are getting loans together, like some members here in Rat Race? How do you run that?
So you mean basically like if two of you guys were looking to qualify to purchase a home together?
Would two people have to qualify together?
No, not necessarily. There's a couple different ways. You can always, so you have to purchase the property under your personal credit. So I get this question a lot, to where can they buy it under a business or buy it under a trust or buy it under an LLC? And you can only do that in commercial financing. To the best of my knowledge, we're not able to do that on any residential. So in this case, you would basically just have one of the partners qualify on their own to buy that property. And then essentially afterwards, we usually recommend, off the record a little bit, technically you're not supposed to put someone else on title immediately, because it can call the note due in full from the lender. Let's say like you fund a loan, they record it with the county. A month later, you go and add another party. That lender would be notified if it happened that quick. So I always tell people, wait about 6 months to add that second or third or whichever parties you're going to be adding to the title, and then just drop a separate contract off to the side. And then however you guys decide to divvy up the profits on your income tax returns, all the write-offs on your Schedule E and so on, that you guys have the ability to do that at that time. But basically, we would just be doing the purchase under that individual. That'd probably be the easiest way to make that happen.
Interesting. Okay, cool.
Yeah,
There's some
or
question-
you guys, you could have two people qualify as equal borrowers, and then basically we have it all under one loan, but with two separate 1003s or two separate applications. That way, you guys aren't, intermingling or seeing each other's all your personal business, but we can essentially write the loan under both of you as equal partners or equal primary borrowers.
And then both of them are responsible for the full amount of the loan, right?
Correct. Yep.
So that's going to
Now
affect
report
two
on their
people's
personal
DTI
credit.
instead of one, right?
Mm-hmm. Correct.
Okay. So I wouldn't suggest that for you guys here in Rat Race. I would, if you guys are going to partner, do it under one person's name, and then 6 months later, put the other one, and then the other person get a loan the next time, and then you're just partners. They can't ask you your marital status, like just you're gay partners, whatever. Like say, do what you got to do. You don't have to tell them whether you're married or not. You're just partners, like you just whatever. So I would do 6 months with one person and 6 months with the other, and then you guys can get two separate loans. Because if you do it that way, then both you guys are going to be responsible for the same amount of the loan. So the reason the banks do that is because now they got two people on the hook for the same amount of the loan, which is obviously better for them. Nothing against Josh, but like as an investor, I wouldn't do that. I would do one in my name with my business partner. We get a business agreement or a partnership agreement drawn up with a lawyer, $350, and then all right, I'll get the loan the next time or whatever the case may be. So this way you guys don't affect your DTI twice. For example, let's say the loan is 300,000 and we both put our names on it on the beginning, then we both are responsible for 300,000. So that means that your DTI goes way up, versus you get this loan, I get the next loan. You know what I'm saying? Get creative.
Plus, that gives you guys the ability to buy more and acquire more properties as well, because most lenders have a cap as to how many mortgages an individual can have. There's not necessarily a cap as to how many properties you can own, but open mortgages, most lenders cap out at 6. Some cap out at 8. We cap out at 10. But still, that is a limiting number. So if you had two of you buying properties together and you're both on each of those notes, those mortgages are on your credit, you're going to be limited to that 10 between the two of you. But if you guys do it individually, then essentially you could purchase up to 20.